Welcome back. In this final part on financial analysis techniques, we continue with our discussion on ratios and quantities in the context of equity and credit analysis. We shall also cover segment reporting and briefly discuss the models analysts build to forecast future profits and cash flows. Let's get started. Equity analysis involves evaluating a company's performance and valuing its equity in order to assess its relative attractiveness as an investment. Analysts use a variety of methods to value a company's equity. This includes valuation ratios, discounted cash flow approaches, and residual income approaches. We shall address the use of valuation ratios and other quantities related to valuing equities in this section. The most widely used valuation ratio is the price-to-earnings ratio, more commonly abbreviated as the P/E ratio. It expresses the relationship between the price per share and the amount of earnings attributable to a single share. In other words, it tells us how much an investor in common stock pays per dollar of earnings. Recall this equation for basic EPS from the topic on understanding income statements. Because net income is generally considered to be more susceptible to manipulation, some analysts use price to cash flow as an alternative measure. One drawback to these price to earnings and the price to cash flow ratios is that they are not useful when the earnings or cash flow is negative. In such a case, the price to sales is an alternative comparative price metric when a company does not have positive net income or cash flow. It's calculated simply by dividing the price per share to the sales per share. Another price-based ratio that facilitates comparisons of stock prices is the price-to-book value, or PB ratio. The book value per share can be calculated as total shareholder equity minus preferred equity divided by the total number of outstanding shares. This ratio is often interpreted as an indicator of market judgment about the relationship between a company's required rate of return and its actual rate of return. Assuming that book values reflect the fair values of the assets, a price-to-book ratio of 1 can be interpreted as an indicator that the company's future returns are expected to be exactly equal to the returns required by the market. A ratio greater than 1 would indicate that the future profitability is expected to exceed the required rate of return. And when this ratio is less than 1, it may indicate that the company is not expected to earn excess returns. Per share quantities include earnings per share. We have learned in the earlier topic on understanding income statements that earnings per share can be expressed as basic EPS and diluted EPS. Basic EPS is net income minus preferred dividends divided by the weighted average number of common shares outstanding. Diluted EPS is the EPS that could have been reported if all potentially dilutive securities are converted into common stock. Potentially dilutive securities include convertible debt, convertible preferred stock, options, and warrants issued by the company. Other per-share measures include cash flow per share, EBITDA per share, and dividends per share. Note that if there are changes to the number of outstanding shares during the period, the weighted average number of shares should be used. Do refer back to the lessons on earnings per share on how to calculate basic and diluted EPS and weighted average number of shares. Also note that the denominator should match the numerator. For example, net income and dividends are attributed only to common shareholders. As such, the denominator should include only common shares. The dividend payout ratio measures the percentage of earnings that the company pays out as dividends to shareholders. The amount of dividends per share tends to be relatively fixed. Companies tend to smooth out dividend payouts to reduce volatility in its share price. Net income, on the other hand, tends to vary due to business cycles. As such, the dividend payout ratio tends to fluctuate with earnings. Conclusions about a company's dividend payout policies should therefore be based on the payout over a number of periods. The retention rate is the complement of the dividend payout ratio. It can be viewed as the proportion of earnings that the company retains and have the potential to grow the company. A company's sustainable growth rate is viewed as a function of its profitability, measured as ROE, and the proportion of earnings that are retained that can realize this growth, measured as the retention rate. The sustainable growth rate can therefore be viewed as how fast a firm can grow without additional capital from external sources. A higher ROE and a higher retention rate result in a higher sustainable growth rate. A universally accepted definition and classification of ratios does not exist. Industry-specific ratios reflect the different ratios that are considered important to a particular industry. For example, companies in the retail industry may report growth in same-store sales. In the retail industry, it is important to distinguish between growth that results from opening new stores and growth that results from generating more sales at existing stores. Another ratio specific to the retail industry is the sales per square foot, measured by dividing revenue with the total retail space. Service companies commonly report the revenue per employee and the net income per employee. In regulated industries like the financial sector, companies are often required to comply with specific regulatory ratios. Capital adequacy typically refers to the ratio of some component of capital to some dollar measure of the risk involved, both operational and financial. For instance, banks are subject to minimum reserve requirements. The cash reserve ratio is the ratio of the reserves the bank holds in the central bank to the specified deposit liabilities that the bank holds. The liquid asset ratio is the ratio of approved readily marketable securities to the specified deposit liabilities that the bank holds. Another important ratio for financial companies is the net interest margin. This is simply the interest income divided by the firm's interest-earning assets. Ratios are also used extensively in credit analysis, which is the assessment of a company's ability to service and repay its debt. Credit analysis is covered in detail in the fixed income course under risk analysis, so we shall just briefly cover them here. The interest coverage ratios, as we have discussed earlier, measure how comfortably a company can pay its interest obligations. The numerator can be EBIT, EBITDA, or funds from operations. Funds from operations is defined as net income adjusted for non-cash items. The return on capital is a measure of the profitability of the firm. The more profitable a firm is, the more likely the firm is able to meet its debt obligations. The debt-to-assets ratio measures the solvency of the firm. The smaller this ratio, the smaller is the firm's debt with respect to its assets, and the higher the firm's ability to meet its debt obligations. The other ratios focus on the various cash flows to total debt. These will be covered in the fixed income course. One of the major shortcomings with ratios is that it may be difficult to make meaningful comparisons when it comes to conglomerates. When we look at conglomerate results, we are looking at all of the divisions and segments of the conglomerate. It's very difficult to find any meaningful benchmark for conglomerates, as the composition of one conglomerate is unlikely to be comparable with that of another. The good news is that both US GAAP and IFRS require companies to report segment data. By definition, a business segment is one that accounts for more than 10% of the parent company's revenues or assets and is distinguishable from the company's other lines. Geographic segments are also identified if they account for more than 10% of the company's revenues or assets and have a business environment that is different from that of other segments of the company's business. For each reportable segment, the firm has to report limited financial statement information. Primary segments must report revenue, both internal and external, depreciation and amortization, operating profit, assets, liabilities, and capital expenditures. Based on this segment information, a variety of useful ratios can be computed. The segment margin measures the operating profitability of the segment relative to revenues, whereas the segment ROA measures the operating profitability relative to assets. Segment turnover measures the overall efficiency of the segment, how much revenue is generated per unit of assets. The segment debt ratio examines the level of liabilities and hence the solvency of the segment. To conclude this topic on financial analysis techniques, let's go back to where we started. The primary focus of this topic is on phases 3 and 4, processing and analysing data. We've learnt the various tools and techniques commonly used to process financial statement data into formats that facilitate analysis. These include common size analysis, graphical analysis, regression analysis, and ratio analysis. The results of an analyst's final analysis, including ratio and common size analysis, are integrated with other data to build a model to forecast future performance. Such data include the assumptions and judgment of the analysts, and economic and industry data. Forecasts can be presented in the form of pro forma financial statements. Pro forma financial statements are widely used in financial forecasting and are often presented to credit analysts and others in obtaining external financing. The forecasts are often not limited to a single point estimate, but should involve a range of possibilities. There are 3 methods of examining the variability of financial outcomes around point estimates: sensitivity analysis, scenario analysis, and simulation. Sensitivity analysis, also known as what-if analysis, is based on questions such as: what will be the effect on net income if the costs increase by 5% rather than the estimated 3%? It shows the range of possible outcomes as specific assumptions are changed. Scenario analysis is based on specific scenarios and will also yield a range of values for financial statement items. Such scenarios can include economic events, like the loss of a key customer, or a catastrophic event that affects the business. Simulation is a technique in which a computer is used to generate a distribution of values for outcomes based on repeated random selection of values for key variables. One commonly used technique is the Monte Carlo simulation. And that concludes this topic on financial analysis techniques. Subsequent topics will cover specific categories of assets and liabilities, starting with inventories. See you again.